One of the things that is really interesting about what you do, Bob, something that I really respect is you have this options knowledge that you bring to the table, along with your technical analysis, your swing trading mentality, and so you're kind of combining these things to really get the most that you can out of the market with some really fascinating ways in which you manage your risk. I think that's the important part.
That's exactly right, Justin. And it's all about managing risk. And I can tell you, I can go back to a time when, I was trading a lot of stocks. This is before I was into options trading back in the late 90s. You and I both remember that whole dot-com period where it was like the Wild West out there in terms of technology, and people thought things were going to, it was like trees growing to the sky forever and never going to, the market was never going to go down. But we of course know that that's not true. And I lived during a time where, I did make a lot of money, but I didn't manage my risk carefully enough. So the one most important lesson I learned from that time period was to manage risk. The beauty of options is that you can define your risk. You know exactly how much you can lose. And that's an important factor that is lost on people who trade options. They don't understand, they don't remember the fact that, hey, look, if I buy a call for $8, that's the most, I can only lose $800. That's it. I can't lose any more than that. I can certainly make much more, but I know exactly where my risk is at.
One of the things you and I were talking about on Monday when we got together was this whole idea of FOMO. And again, you look at how much this market has come up. There was a lot of wringing of hands in terms of the tariff situation. It was introducing a big unknown. There were a lot of there still are a lot of arguments over what this is going to do to the economy, and everything like that. And look, I'm not smart enough to know. I just look at the chart. I let the market decide, and I go from there. But certainly at this point, the fear of missing out is strong, right? If you didn't get in early, you've been kind of looking from the outside and looking for your opportunity, and this has just been trending up in such a strong way. So how do you, if you're doing some of these short-term options, how do you kind of get new positions to keep on participating here in this market when some of these are limited in terms of their expiration? And okay, you're out of that trade. Now what?
Well, there's a couple of things there. The first thing is that I learned a long time ago the best trends barely give you a chance to get in. And that means basically, the best trading trends do not give you an opportunity to get involved and to get a position on. The market, the stocks or the indices, they don't dip long enough in terms of time or duration to give you that opportunity to get in. Maybe today it was only like the last hour of the trading day to get in. That's a very small window, Justin, if you're thinking in terms of the bigger picture here. But by the same token, I look at market volatility in the 14, 15, 16% range, and I have to say to myself, look, while there's a lot of complacency in the market, we've been down here for quite some time, and we've been coming down from higher levels. Remember, back in April, we were at 60% on the VIX. We've come down quite a bit, and I have to figure that the market is fairly confident that we're not going to have any big surprises right now. I always want to have some insurance on. I always have some puts on, and they really rose up in value towards the end of the day today. They're probably going to get smashed tomorrow, and I'm okay with that. I got to have some balance there, and that balance of having some puts on because the markets go down a lot faster than they go up, and having some calls on gives me that balance there to eliminate some of the market volatility that's in my portfolios. But I can still make some good money on the upside if my calls are correct.
Yeah, and you know what? I think that's something that a lot of people forget in terms of with some of those puts that you might be putting on. You're more than okay for those trades to not work out. It's one of those things where if it's hedging something, if it's giving you that insurance, who cares if you paid a little premium for insurance when your house is protected, right?
Right.
No one complains. Oh well, gosh darn, my house didn't burn down and I didn't get the value of that premium. So yeah, it's really again, you have to kind of change your mindset instead of looking at like, oh, those puts were worthless and I didn't make any money on them.
Exactly right. And I look at it in terms of like, we pay for insurance every month for stuff like life insurance, health insurance, auto insurance, mortgage insurance, those sort of things. And we hate writing those checks, but we're happy if a disaster happens. It's no different than what we're doing in the stock market these days. Investors protecting our portfolios. I'm happy writing that or buying that put if it's going to protect me against some downside risk of the markets, which I have no control over, and I really can't. If I don't see it coming out in the future, nobody can see the future. Nobody's Nostradamus. If we can't see what's happening into the future, well, I mean, we could get clipped at a moment's notice, and if I don't have any protection on, I'm gonna be in a world of hurt.